You could call it a tale of two central banks. A week ago, Canada's central bank brought its benchmark interest rate to 4.75%. It was the first among the G7 to cut. Meanwhile, the U.S. central bank is holding its federal funds rate at a 23-year high and is signaling there's just one rate cut in the cards this year. The Bank of Canada's monetary policy has an immediate impact on variable rate debt, including variable rate mortgages. But what the U.S. central bank does has a bigger effect on the bond market and fixed lending rates. Desjardins economist Randall Bartlett says not to expect a rate cut from the U.S. Federal Reserve until the fall.
If we see that longer-term U.S. yields remain higher, that could have implications for 5-year borrowing costs. So for fixed-rate mortgages, that could have implications for 10 and 30-year government bonds.
Meanwhile, the Bank of Canada is widely expected to be in a position to cut by another quarter point in July. All of this has an impact on our dollar and the divergent paths of our monetary policies likely to boost the U.S. dollar. A weaker loonie makes U.S. imports more expensive, which could reignite inflation in Canada. Another worry is the wave of mortgages up for renewal this year and next.
We've characterized the upcoming mortgage renewals as a ticking time bomb in Canada. We're not expecting it to lead to a recession, but we are expecting to see materially lower consumption growth and residential investment.
The decisions of both our central bank and the U.S. Federal Reserve have significant impacts on borrowing costs across Canada, from mortgages and auto loans to credit cards and other forms of consumer and business borrowing. Anne Gaviola, Global News, Toronto.